So today we're going to talk about the 4% rule for Canadians and why it doesn't work anymore. I get this question quite often. Now, if you're planning your retirement around the 4% rule, you might be planning your retirement around a myth. That's right, the famous US-based 4% withdrawal rule that everyone from your buddy at the golf course to your favorite finance blogger talks about. It's dangerously outdated for Canadians. And in 2025, using it blindly could mean the difference between retirement that succeeds and one that collapses 10 to 15 years too early. I'm going to show you why the 4% rule doesn't work in Canada, what the new reality looks like, and a quick case study showing how applying the wrong rule can cost you hundreds of thousands of dollars in retirement. Now, where did the 4% rule come from and why is it flawed? The 4% rule came from a 1994 US study that looked at American markets and American tax rules during a very specific period of time. Now, here's the problem. It was based entirely on the US stock and bond returns, not the Canadian ones. It assumed interest rates would stay fairly stable, and they didn't. It assumed inflation would remain modest, also wrong. And it didn't factor in Canada's tax system, CPP, OAS, TFSA withdrawals, or something most Canadians underestimate, the OAS clawback. So what's the result? A rule that might have worked 20 to 30 years ago for Americans in a very different world, but cracks under today's Canadian retirement math. Now here's three big reasons the 4% rule fails in Canada. Number one, inflation hits the Canadian economy differently. We're paying more for groceries, real estate, property taxes, medical coverage, travel, and those costs are growing faster than US inflation. A rule created for 2% inflation doesn't survive in a 3 to 5% environment. Number two, Canadian taxes make withdrawals more complicated. The 4% rule ignores RSP RIF forced withdrawal schedules. It ignores OAS clawbacks starting at $90,000 of income, dividend gross-ups, capital gains timing, sequence of return risk on Canadian portfolios. A simple withdrawal strategy doesn't hold up in a tax system with this many moving parts. Number three, bond yields are lower than the original study assumed. The original rule depended on strong bond returns. Now, Canadian fixed income today doesn't behave the same way, and when yields are lower, the safe withdrawal rate drops. Today, many Canadian retirees are closer to a 3% safe range and not 4%. So what actually works in 2025? Instead of a fixed 4% forever, smart Canadian retirement planning uses dynamic withdrawals, which means adjusting income slightly depending on the markets and inflation. It also looks at tax-efficient withdrawal orders, typically using RSP RIF, non-registered, and TFSA, but customized based on the client's income, age, and clawback exposure. Smoothing income to protect OAS, this alone can save Canadians $5,000 to $15,000 a year. A portfolio designed for retirement, not growth. 20 to 30% fixed income, 60 to 70% diversified equities, and 10 to 20% alternatives or cash buffers. And the final piece, retirement testing using Canadian data, not US Monte Carlo simulations, not outdated spreadsheets, Canadian retirement math. When we model withdrawals using Canadian taxation, Canadian inflation, and modern market returns, the picture changes dramatically. So let's look at John and Mary. They're both 65, they live in Kelowna, they have about $1.2 million in investments, they have a balanced portfolio, they'll have CPP and OAS, and they plan to travel for the first 10 years. They follow the old 4% rule. So 1.2 million times 4% is $48,000 a year. Combined with CPP and OAS, their total income hits around $100,000. Sounds good, right? Wrong. Here's what happens. Their RIF withdrawals push their income above the OAS clawback threshold. Taxes and clawbacks take a bigger bite than expected. Inflation causes their lifestyle costs to rise 3 to 4% a year, and by their mid-80s, their investment balance is dangerously low. They run out of money around age 86 in our Canadian model. So we ran the numbers again. This time, a 3.5% dynamic withdrawal rate, smooth RIF income, TFSA used more aggressively, non-registered drawn down more early, income kept under the clawback line. And here's the result. Instead of running out of money at age 86, their money now lasts to 97 with a 90% success probability. Same couple, same savings, just a smarter Canadian strategy. So here's the takeaway. The 4% rule is simple, but retirement is not. And for Canadians, clinging to it today is like following a map from 1990 and expecting it to get you through Vancouver traffic in 2025. Your retirement deserves better math and a better strategy, and a plan built for Canadian taxes, Canadian inflation, Canadian markets, and your goals. Now, if you're within 10 years of retirement or already retired, we can help. Hit the subscribe button to see my weekly videos. There's also a link below for my retirement readiness quiz, which only takes 60 seconds. And you can also book an appointment with me directly through my Calendly link. So don't leave your retirement to guesswork. We've helped hundreds of Canadians build tax-efficient, long-lasting retirement plans. So thank you for stopping by, and we'll see you in the next video.